Bitcoin is preparing for a massive recovery, but if you don't understand the structural machine operating beneath the surface right now, that recovery isn't going to benefit you at all. We just witnessed one of the sharpest weekly dumps that Bitcoin has seen in months. Millions in longs were liquidated. The sentiment has shifted to pure fear, and everyone across the financial space is obsessing over the exact same question. When do we finally turn back around? But there's a massive blind spot in the standard retail perspective. This entire flush, and the recovery that will follow it, is being actively engineered by the exact same legacy institutions that spent the last year turning Bitcoin into a regulated Wall Street financial vehicle. They are doing this because their entire long-term corporate growth strategy completely relies on it. This is not an emotional guess or a speculative prediction. It is a highly documentable market pattern. It is the exact same playbook that structurally captured crypto years ago. In this video, I'm going to lay out two concrete truths. First, the corporate entities that the mainstream media claims are bleeding from the crash are actually the ones setting the floor. Second, I'm going to show you the precise data-driven technical levels and the timeframes where this final shakeout will hit its absolute bottom. We will also discuss what to expect for Bitcoin's price this summer. You will have zero confusion after watching this video about where Bitcoin is headed and what is really moving the price. If you have any questions along the way, comment them as they come and I will clarify anything. So let's start right away. The biggest myth dominating the media right now is the idea that the massive spot ETF issuers like BlackRock or Fidelity are hurting when the market takes a dive. They aren't losing a dime of their own capital. That's the real truth. To understand why they aren't panicking, you have to understand the business model of a spot ETF. An ETF is fundamentally a pass-through asset wrapper. The institutional issuer simply buys and custody holds the underlying asset, in this case Bitcoin, to back the shares traded on the equity market. In exchange, they charge a fixed management fee based entirely on their total assets under management, or AUM. When the spot price drops 20 or 30%, the corporate issuers don't take a balance sheet hit. The retail buyers and over-leveraged treasury funds, they're the ones who take the hit, at 100% of the capital destruction. The issuer's only penalty is a microscopic reduction in their daily management fee percentage. They are entirely protected from directional price risk. So Wall Street isn't afraid of a lower spot price. In fact, a lower price provides them with a cleaner entry to expand their footprint. What they cannot survive is a flatlined growth on their corporate charts. The entire multi-trillion-dollar expansion of these legacy institutions relies on a singular micro-transition. Changing Bitcoin from an unbacked speculative asset that retail traders flip for quick fiat profits into a permanent, structured asset class where global institutions allocate capital for the next 30 years. We're talking about the largest capital pools on Earth: pension funds, massive university endowments, and sovereign wealth funds. That is sticky, permanent capital that sits untouched for a decade. Quick note for you all. Institutional allocation rules. High volatility risk assets, these are placed in a speculative tech buckets, subject to aggressive selling during macro tightening. Now let's discuss high volatility risk assets. These are placed in a speculative tech buckets, subject to aggressive selling during macro tightening. Then we have stores of value, think of gold and T-bills. These are granted permanent, multi-decade capital allocations that remain untouched during market cycles. Conservative fund allocation committee will never put a hyper-volatile, massive drawdown speculative asset into their portfolio position where historically it was reserved for physical gold or treasury bills. This is the core motive driving the market structure. The legacy institutions that integrated Bitcoin into global equity markets are the same exact entities whose corporate growth demands that Bitcoin stabilizes. They need the digital gold narrative to manifest as a statistical reality. Not because they care about financial decentralization, but because their fee compounding model cannot scale without it. They don't need to coordinate in secret. Their shared corporate incentives dictate their actions perfectly. And if the most capitalized institutions on the planet require a market stabilization and recovery, the ultimate outcome is practically a mathematical certainty. The real question isn't whether markets recover. The real question is this: where is the line in the sand where the smart money steps in to establish the floor? Let's dive straight into the charts to look at the exact numbers. If you have any questions along the way, comment as they come and I will clarify anything. When we want to track where the actual smart money is preparing to bid, You have to look past the noisy daily charts and focus on macro historical indicators. These indicators have caught every single cycle low. This is the part in the video where you may need to replay it a few times if deep technical analysis is something you're unfamiliar with. But it is absolutely worth it to spend a few more minutes understanding this process if it means you can time Bitcoin's next move just right. So let's begin. If we zoom out to the higher time frame charts and examine the last two definite bear market cycles, specifically the liquidity event of the COVID capitulation lows and the absolute bottom of the 2022 bear market, Bitcoin found its definite floor at a highly specific technical intersection, the 12-day 200 EMA and SMA. On the 12-day macro time frame, the 200 EMA and SMA have acted as the ultimate historical line in the sand. Furthermore, during the last macro cyclical bear market, the price action found its macro floor precisely at the 1.5 fib retracement level. For the past several months, the data has indicated that we would inevitably need to test the 12-day 200 EMA and SMA during the corrective phase to clear out the late cycle leverage. We recently saw a brief tag of the weekly 200 SMA, but on the 12-day time frame, which is the specific time frame responsible for catching the absolute bottom of the last two bear markets, our ultimate target sits in a clearly defined structural window. The macro range currently maps out between 56,000 and 44,000. For the rest of this video, we will refer to this as the macro zone, so keep that number in mind. This is the primary macro window where Bitcoin is mathematically grinding down to establish its true cycle bottom. Now is the part where the worst case scenario must be stated. Yes, there is an extreme downside target sitting at $34,000, but it's vital to understand the context of that number. If Bitcoin ever prints a candle down to the 34K level, it will not be driven by standard, healthy 4-year crypto market cycles. It would be the direct result of a severe global macroeconomic black swan event, like an aggressive systematic liquidity crunch across traditional equity markets. This would drag all global risk assets down with it. We also can see on our liquidity heat map that the brunt of the liquidity is sitting in our macro zone literally precisely. Barring a total macroeconomic collapse, the structural target remains firmly rooted inside that zone. Price levels are only one half of the puzzle. The second, more critical component that most retail traders completely ignore is the element of time. An asset doesn't immediately launch into a macro recovery just because a retail investor feels it has dropped long enough. The massive long-term institutional capital that I've been describing hasn't actually stepped into the market yet. Spot ETF flows have consistently printed negative data points over the last several weeks. We recently witnessed a singular massive institutional exit over $1.26 billion in value. A transaction of that scale isn't a standard algorithmic rebalancing trade. That is a major corporate allocator actively de-risking and moving to the sidelines. So when does the tide actually turn? The chart patterns give us the exact price levels and the exact timeline, but to truly protect your capital, you have to understand the broader macroeconomic environment occurring while retail is distracted by short-term price volatility. Using classical economic principles, over 2 centuries ago, the entrenched owners of society's financial infrastructures never tried to outright ban or destroy a fundamentally disruptive new technology. They know that a truly decentralized innovation cannot be completely stopped. Instead, they execute a much more sophisticated strategy. They step back. They let the initial Wild West phase play out. And then they use their immense political leverage to completely rewrite the regulatory frameworks regarding it. By doing this, they ensured that the only version of the technology allowed to legally survive is the precise version that they completely own and control. This is the phase Bitcoin is navigating right now. Step 1 was the institutional vehicle, spot ETF. This successfully migrated a massive portion of Bitcoin's circulating supply off of open, sovereign, peer-to-peer networks and locked it behind Wall Street. Step 2 is the legislative annexation. This is the part that is taking place in real time. While everyday retail investors are panicking over daily red candles on their screens, corporate lobbyists in Washington, D.C. are actively draining the permanent regulatory framework for digital assets. The entities with the most seats and influence in those regulatory rooms aren't everyday retail investors. So here's how it all plays out. Sometime during that July to October window, Bitcoin hits its measured macro targets. The leverage retail positions are thoroughly liquidated, the liquidity heat map is swept clean, and the whale indicators print an absolute bottom. at the exact moment of maximum retail despair. The institutional desks quietly step in and absorb the float. When the recovery eventually manifests, it will be heavily broadcasted across corporate financial networks as a glorious validation. Proof that the asset class has finally achieved mainstream legitimacy. But by the time the average retail investor feels safe enough to buy back into the market at new all-time highs, the underlying asset they are purchasing will have been entirely hollowed out. It will no longer be the permissionless, parallel financial system designed to bypass centralized gatekeepers. It will be a highly regulated, thoroughly sanitized Wall Street financial product sanctioned by federal regulators and priced to extract maximum premium for the benefit of institutional shareholders. You weren't invited early to the future of finance. You were intentionally invited late. The most important part of this for you to understand is how this plays out in the next 4 to 5 months. If you can understand that, you will be fine. Down below, I offer free updates on the bear market. Like and subscribe if you found value from this video. Comment any questions you have and I will answer them all. Peace.